In this presentation, we will continue on with the statement of cash flows, financing activities, taking a look at cash received from issuing stock. For more accounting information and accounting courses, visit our website at accountinginstruction.info. We're going to be using this information, the comparative balance sheet, income statement, and the additional information, focusing here on the comparative balance sheet to make this worksheet. We're taking these differences in order to construct our statement of cash flows. We had the cash flows from operations, cash flows from investing activities. We're now working on the cash flows from financing activities. We found a home so far for all of these numbers, except down here we're looking at the common stock and paid in capital. So those are going to be the numbers we here are focusing on, common stock and paid in capital. Now those two, we're probably looking at them and saying, well, they're probably not an operating activity. But if we go through our thought process, we would say, what happened here? Well, common stock went from 200,000 up to 215. Paid in capital went from 0 to 30,000. So they increased. And why would that happen? Well, it must be that we issued stock. That would typically be what happened. So if this was a sole proprietorship or partnership, then it could be, this would be similar to like the investment, the owners putting money into the partnership, putting more investment into the partnership. Well, if that's the case, then if we look at the journal entry for that, we'd say, well, then we probably debited cash and we credited common stock and paid in capital. And note that there's nothing involving an income statement account, no revenue or expense, and therefore it's probably not going to be the operating activity. And then I would ask, did we purchase anything? I was like, no, we didn't purchase anything. The owners purchased the stock. The owners purchased investment in the company, but the company didn't purchase any assets. So it's not all that means it's going to be a financing activity. So it's not investing, it's going to be financing. The company got money from the owner. The owner is financing the company, it's giving capital to the company. So it's going to be a financing activity that we're going to have here. And we'll of course say that cash received from issuing stock is going to be the 45. Now the only confusing thing here is that of course we're going to group, this is the one case where we're not finding a separate home for these two. Why is that? Because remember that when we issue the common stock, we usually issue it at par value. And then, so we debit cash for whatever we get. And then we credit common stock for the par value to make it all even. And then we credit paid in capital. So these two accounts are really kind of intimately linked. And therefore the 30,000 and the 40,000 kind of go together. And so we're going to increase this by the 45,000. So we'll put them together. And we would think that we would be pretty good there, that full 45,000 is probably due to the issuance of stock. Now again, we don't issue stock all the time. If you think about the stock exchange where they're trading stock all the time, that's because it's not an initial offering. Those aren't offerings from the company typically. They're just buying and selling from other people, other investors. The money, the investments to the company from the owners, the issuance of stock, hopefully it doesn't happen all that much, because that would mean that the owners keep on having to finance the company. So it's going to be another area where there will be few transactions. If we want to check that number and see if there's anything else that happened there, we can go into the common stock general ledger account and just see what's the activity and just see exactly what's happening. In other words, there's not going to be a whole lot of detail as there would, say, in the cash account for the GL in the common stock and paid in capital. So we can go in there and say, okay, what is this difference from? And there shouldn't be too much going on for us to figure that out. And most likely, of course, it would be a sale that happened. Once we have this information, we can sum this up. So the 5,000 to 22,500, the 45,000 adds up to the 72,500. So what we have now is the cash flows from operating activities that we brought out to the outer column here, summing up all of this, bringing it to the outer column, cash flows from operating, cash flows from investing, only having this one item here. So we bring that out to the outside. And there'll be more items when we do the adjustments. But then we have the cash flows from financing activities, including these items, bring it out to the outside. And then if we are to add these up, then we're going to say the operating activities, 51650 minus the 62250 plus the 725 is going to be the 619. So that adds up to that 61.9. Remember, that's the one we kind of left alone. We put it down here to see where we're going. And now we're kind of verifying, okay, that looks right. And then what we really want to do is get back to this number, because this is kind of our end goal here, but it only ties out to our worksheet. And we want to make it really easy for the readers of the financial statements not to tie out. We don't want to make them do math to figure out the difference between these two periods as they could with the balance sheet. We want to basically make it easy for them and do the math for them. So we're just going to say, okay, here's the cash at the beginning of the year, which is the 61.5. So this plus this gives us to the cash at the end of the year, hit this number here. So this is really kind of the number we're looking for. That's the change. And then we're going to say, okay, let's get back to this number, because that'll be really easy for them to tie out to the balance sheet number, which will be that number here. So this is going to be the full process. Now note, now we have something that's in balance from doing this. We can say, okay, this whole thing works. However, it's not right, because the income statement, as anybody will tell you if they watch you put this together, the first thing they'll say is that number's wrong because it doesn't tie out to net income on the income statement. And we know that this number is going to need some adjustments and whatnot. But what we do have is something that works. It's in balance. Whereas we would not have that if we just start pulling numbers from the income statement that don't tie into our worksheet at all. So what we want to do now is go, okay, now we've got something that works. Let's fix these systematically one by one in such a way that we remain in balance after each step, kind of like we would if we were doing journal entries. So we'll use the same kind of journal entry, double entry accounting type of thought process to do adjustments here that will hopefully leave us in a position where we remain to be where we know we're correct. For more accounting information and accounting courses, visit our website at accountinginstruction.info.